Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing DocuSign stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 10 billion market cap. They're trading at $50 a share and they have 200 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow looks really good. It grows from 215 million to the highest ever in the trailing 12 months, 547 million. Net income paints a different story. That's negative each year, but it is improving a lot. The negative is really small in the trailing 12 months, almost break even. But they are generating positive free cash flow. That's the most important thing. Why is net income negative but free cash flow positive? Maybe they have a lot of write-offs, a lot of impairments, like an asset impairment. Another thing lots of companies do is pass through stock-based compensation, where they give their employees stock. That's an expense that brings down your net income, but it doesn't affect cash flow because stock doesn't cost the company cash. Or they could be losses, depreciation, and amortization. Those are non-cash expenses that bring down your net income but don't affect cash flow. Those are the main reasons, but there's a lot of others. Revenue is the sales for the company, and that also looks really good. It grows from 1.5 billion to 2.7 billion. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 12 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $10.6 billion. We divide that by 200 million shares. And we get a calculated stock price of $52. They're trading at $50, so they're trading at a 4% discount. It's a small buy according to the model. In 2021, the stock got to its highest level ever, over $300 a share. But it finally appears they're trading around intrinsic value. It's just crazy how a stock goes up so much and down so much. It makes you think, should I have shorted it? Should I have longed it? But the future is always unknown. There are 254 companies in the same industry as DocuSign, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 87 million in CapEx. Software companies generally have low CapEx, unless they do manufacturing, but most of these companies don't do manufacturing, so their CapEx is fairly low. Their debt to equity ratio is 1.0 between the median and average, so that means for every dollar of equity, they have $1 of debt. They don't pay a dividend. Only 3 companies in the top 20 do pay a dividend. They generate more free cash flow than the average company. Salesforce is number 1. Salesforce is also the largest company on this list. DocuSign is 35th on the list, 10 billion market cap. DocuSign's price to book is worse than the median, but a lot better than the average. We can't look at their PE since they have negative earnings. Roper Technology has a best PE, never heard of them, in 18. Their price to free cash flow is better than the median average. SAP is number 1. SAP has the best price to free cash flow, price to book, and price to sales of all these companies. DocuSign's price to sales is between the median and average. They generate a lot more revenue than the average company, and they're growing a ton, 35%. Shopify is the highest at 49%. That's a really high growth rate. If you put $10,000 into this company when they IPO'd, it looks like you would have been close to $100,000 at one point, but if you're still holding on, you'd be at $13,000 today. That's a 5% annual return, a 30% total return. So not terrible, but you would be trailing the S&P 500. They just released their 7/31 financials. They beat earnings by 10%. They reported 72 cents a share. The expectation was 66 cents. And they beat revenue by 1.5%. They reported 688 million. They've beaten earnings and revenue now 4 straight quarters. Let's go through their 7/31 financials. This is their second quarter of 2024. Let's go through their income statement. This is the 3 months ending 7/31/2023, the 3 months ending 7/31/2022, and this is the 6 months ending 7/31/2023 and 2022. So revenue for the most recent quarter, 688 million. That's up 11% from the same quarter last year. It was 622 million in 2022. Most of their revenue is subscriptions, 669 million. They also have service revenue of 18 million. Both were up from last year. For the trailing 6 months, revenue of $1.35 billion, up from $1.2 billion. And they have really good margins. All the expenses directly related to generating the $688 million are $145 million. So their gross profit, revenue minus cost of revenue, is $542 million, up from $485 million. Marketing of $300 million, that is down from last year. R&D is up, that's $136 million. G&A, general and administrative expenses, $104 million. So their operating expenses are $535 million, up a little from last year. So they have positive operating income. I think this is their first quarter ever with positive operating income. Last year they had negative $42 million. Their net income for the quarter is also positive, $7.4 million, compared to a loss from last year of $45 million. So their EPS is 4 cents. 204 million shares outstanding. That is up from last year of 201 million. Look at all the stock-based compensation. That's why their net income is low, but their cash flow is high. 13 million, 8 million, 52 million, 45 million, 35 million. So if the employee that receives the stock-based compensation is in a marketing department, you'll see their stock-based compensation in sales and marketing. If there's an employee that works in R&D and they receive stock-based compensation, their number will show up on this 45 million. Let's look at their balance sheet. Total current assets, $2 billion. Current liabilities, $2.2 billion. That's not a good sign. They're not bringing in that much free cash flow, but it is positive, their free cash flow. If it was negative and they had a current ratio below 1, that would be a big problem, because that means they would need to take on debt or issue more stock to fund their business over the next year. They have $1 billion in cash, up from $720 million 6 months ago. They also have $420 million of investments, so you can think of this as cash. So it's like they have $1.5 billion of cash. Accounts receivables, this is how much money their customers owe them when they sell on credit. They have lots of goodwill, $350 million. This is from acquisitions. $370 million of deferred contract acquisitions. These are expenses a company defers in relation to acquiring new customers or new businesses. So they carry those expenses on the balance sheet and amortize them onto the income statement over a certain period of time. A contract liability is when a customer pays in advance under the terms of a contract. When DocuSign provides a service, then they move some of that dollar amount off the balance sheet and onto the income statement. Let's look at the equity section of their balance sheet. They raised $2.5 billion from selling stock, selling their business, and they lost $1.7 billion from running their business. Accumulated deficit is the sum of all their prior net incomes. Let's take a look at the statement of cash flows. The way you calculate operating cash flow, you start with your net income, $7.4 million. Then you add back the non-cash items on the income statement. The big one is stock-based compensation, $150 million. You also have amortization and depreciation. You have to adjust for changes in working capital. So they generated $211 million of cash flow. Last year they generated $121 million, even though they reported a loss of $45 million. Because look how much stock-based compensation brought down their net income. That's a $141 million expense. So if it wasn't for stock-based compensation, they would report positive net income. In the investing section, they spent $27 million on property, plant, and equipment, almost double last year's of $15 million. In the investing section, they bought back $30 million of stock. They paid $40 million in taxes on restricted stock units and employee stock purchase plan. This is related to stock-based compensation. So they had a cash outflow of $69 million in their financing section. Let's look at the company on Simply Wall Street. Its last price was $50, 10.5 billion market cap, down 3% in the past week, down 22% in the past year. Let's see if we can learn a little more about the company. Their business model is providing electronic signature solutions in the US and around the world. They provide DocuSign e-signature solution that enables sending and signing of agreements on various devices. So you could sign a legal contract electronically through DocuSign. Contract lifecycle management automates workflows across the entire agreement process. And Gen for Salesforce allows sales reps to automatically generate agreements with a few clicks. And that's within the Salesforce application. They also provide identity, a signer identification option for checking government-issued IDs. Their other product is standard-based signatures, and that supports signatures that involve digital certificates. Another product is Monitor. It uses advanced analytics to track DocuSign e-signature web, mobile, and API. API is Application Programming Interface. They also offer rooms for real estate, and this provides a way for brokers and agents to manage the entire real estate transaction digitally. They have DocuSign Federal and DocuSign CLM, which are tied to FedRAMP. FedRAMP is a US government program. It stands for the Federal Risk and Authorization Management Program. This is an authorized version of DocuSign e-signature for US federal government agencies. Also, life sciences modules that support compliance with electronic signature practices. They sell their products through direct and partner-assisted sales, and also web-based self-service, which is online purchasing. They were incorporated 20 years ago in 2003, located in San Francisco, California. They IPO'd in mid-2018 at $40 a share. It hit its low at the end of 2018. It hit $37. It did break through 300 in 2021, and then it fell off a cliff, hitting its IPO price at the end of 2022. And it's not up that much since IPO. So the stock definitely moves around a lot. Simply Wall Street's valuation is $89. They say the stock is 44% undervalued. 18 analysts priced this stock at $64. So they also say it's undervalued. Their revenue in 2016 is $250 million, and it looks like it grows every single year. It had a pretty aggressive growth since 2021. It's now up to $2.6 billion, and this is for the trailing 12 months. And the forecast by 2026 is $3.2 billion. They were debt-free in 2017, also most of 2018. They added $400 million of debt in 2018. Then it was pretty steady over the next year or two. Then in 2020, they added a bunch of debt. It got up to $750 million. And it hasn't really changed too much. It's currently $725 million. This blue line is their equity, which was higher than their debt, then lower, but now it's higher again. So their debt to equity ratio is 85%. But when you look at the green line, there's not much of a problem because they have lots of cash. They have enough cash to pay off all their debt. They always have more cash than debt, so they're always well capitalized. The CEO's salary is only $260,000, but the total compensation package is $85 million. And his tenure as CEO is less than 1 year. There's only one insider trade in the past year. It was a sell for 1,988 shares. 79% of the company is held by institutions, 20% by the general public, and 1% by insiders. Vanguard is the biggest shareholder at 10%, then BlackRock at 6%, T. Rowe Price at 2.8%, the Australian giant Macquarie 1.3%, JP Morgan 1%, Goldman Sachs 0.88%. Their employee count was 2,300 in 2018. It got up to 7,500 in the beginning of 2022. It fell a little bit to 7,300 currently. The ticker trades in lots of places: the Nasdaq, Deutsche Börse, London Stock Exchange, Mexican Bolsa, Sao Paulo Bolsa, and Buenos Aires. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.